Welcome to the Nifty Noon podcast. Imagine, waking up to find out that the loudest, most militant vegan, was just caught eating a massive dry-aged steak.
Oh, wow. Yeah.
Right. I mean, that is exactly what it felt like in the financial markets this week. The biggest never-sell absolutists suddenly they decided to dump over $1 billion in assets, and that was just the beginning.
It really was. It was a week where, cold, hard pragmatism just violently took the wheel. We are looking at a market that completely rejected ideology in favor of, survival and market share.
Which makes this the perfect time for our deep dive into the latest from our newsletter. Today, we are breaking down a week where regulatory compliance suddenly morphed into this ruthless competitive weapon.
Yeah, weaponized compliance. It's wild.
Exactly. We will look at major corporate treasuries abandoning their famous dogmatic holding strategies just to keep the lights on, traditional finance giants forming a massive syndicate to break a stablecoin monopoly, and retail brokerages just, fully absorbing decentralized finance into their backends.
And if you're keeping score at home, the clear winners this week are the highly compliant platforms. So Coinbase and OKX, along with everyday retail users who are suddenly gaining access to entirely new institutional yield opportunities.
While the losers are just as stark, honestly. Binance watched its European dominance slip away, Circle saw its stablecoin market share come under direct fire, and the entire internet diamond hands narrative just took a massive hit.
A very massive hit, yeah.
So before we jump into the actual mechanics of how all this happened, here's the TLDR you need to keep in mind. First, the MiCA regulatory framework in Europe is now the ultimate kingmaker for liquidity.
Right.
Second, institutional stablecoins are rapidly shifting away from single-issuer monopolies toward shared economic models. And third, retail decentralized finance is no longer a fringe concept. It has been fully integrated into the back end of major consumer apps.
And, the reason you should care about all this institutional maneuvering is actually quite simple. The literal plumbing of the global financial system is being rewritten right in front of us.
It's not just some minor update.
Exactly. These aren't just software patches. These are structural shifts. Understanding how the pipes are moving is, frankly, the difference between catching the incoming wave of capital and being completely crushed by it.
So let's start by looking at what was causing so much anxiety as we entered the week. We have been tracking the European Union's landmark MiCA regulation for a while, and the deadline for compliance finally hit.
Yeah, Monday was tense.
Very. And the immediate casualty was Binance. They failed to secure a license in Greece, which forced them to announce this sweeping suspension of services for all EU clients starting July 1st.
Which is just a staggering operational failure for the world's largest exchange. Withdrawing their application in Greece means they missed the crucial MiCA deadline entirely.
They are signaling that they will pursue authorization in France later on, right?
They are, yeah, but that doesn't solve the immediate problem at all. They created a massive instant liquidity vacuum across Europe. You have millions of users and billions in capital that suddenly, require a regulatory compliant home literally overnight.
And the competitors did not waste a single second. I was looking at our notes, and Coinbase leveraged the MiCA license they have held since 2025 to offer a 5% fund transfer bonus for anyone moving capital over.
Aggressive.
Right. And then OKX countered with an even more aggressive 8% deposit match for eligible European traders. I am looking at this and trying to find a parallel. It feels like the city just passed a strict new zoning law, and the biggest, most popular local nightclub suddenly lost its operating permit right before a major holiday weekend.
Oh, that's a good way to look at it.
Right. The doors are chained shut, thousands of patrons are standing on the sidewalk, and the rifle clubs across the street immediately flood the block with promoters handing out free VIP passes and open bar wristbands.
That is a highly accurate analogy. And it actually answers a question the industry has been debating for years now. Does compliance matter to the bottom line? And the answer is yes. Compliance is no longer just a legal hurdle or, a defensive shield. It is the primary offensive marketing tool for these platforms.
Because without that legal certainty, you can't even get in the game anymore. You're just locked out.
Precisely. For the last decade, the prevailing strategy in this industry was to move fast, launch products globally, and just figure out the regulatory gray areas later. Ask for forgiveness, not permission.
Right, the classic Silicon Valley playbook.
Yeah, but that era is over. A standardized continent-wide framework like MiCA creates a massive protective moat for the players who actually did the hard work of getting licensed early. Because institutional capital, so pension funds, asset managers, corporate treasuries, they physically cannot deploy capital onto an exchange that operates in the shadows.
They need the paperwork.
They require audits, capital reserves, and legal certainty. By being compliant, Coinbase and OKX didn't just win retail users from Binance. They basically secured the exclusive right to onboard Europe's institutional wealth.
Which brings up a really interesting transition, because institutional reality hit another major player this week. We saw a massive structural shift from one of the loudest ideological pillars in the entire market. I'm talking about Strategy Inc.
Oh, man. Yeah, Michael Saylor's firm stepping back from the never sell mantra is arguably the defining moment of the quarter.
It really is. They unveiled something called a digital credit capital framework alongside a Bitcoin monetization program. And the headline that absolutely broke the internet was that this framework allows for the sale of up to $1.25 billion in Bitcoin to bolster their cash reserves.
It was a shock to the system.
A huge shock. You are talking about a company that built its entire identity on accumulating and holding indefinitely. So break down the math for me here, because looking at the sheer financial gravity of their position, it seems like they were backed into a corner.
The math is just unforgiving. So Strategy Inc. holds over 847,000 Bitcoin. Their average cost basis is roughly $75,600 per coin.
Wow, okay.
Yeah, and with the asset currently trading near the $60,000 mark, the corporate treasury is sitting nearly $13 billion underwater. But being underwater isn't actually what forced their hand.
Wait, really? What was the trigger then?
It was their market net asset value, or MNAV. That metric dropped below parity. So in plain terms, the open market on Wall Street was valuing the entire firm at less than the actual raw Bitcoin it holds on its balance sheet.
Okay, that's wild.
It is. And when your MNAV drops below parity, the structural integrity of your entire debt financing model is under severe threat.
I want to make sure I understand this M&AV concept, because it sounds less like a sinking ship and more like, say, a real estate developer whose brand new, unfinished skyscraper is suddenly appraised by the bank for less than the original construction loan. You don't want to abandon the building, obviously, but you suddenly have to sell off the penthouse at a massive discount just to appease the creditors and keep the project alive.
That is a perfect structural analogy. The market lost faith in their ability to service the debt they took on to build the skyscraper in the first place. So they had to institute massive stabilization efforts.
What did those look like?
They announced up to $2 billion in share repurchases across common and preferred shares. They introduced a 12% dividend on their STRC preferred shares, and crucially, they adopted a $2.55 billion U.S. reserve policy to cover over 17 months of dividend and interest obligations.
Okay, stop right there. What exactly does a 12% dividend on STRC preferred shares actually mean in this context? Why does that specifically require selling Bitcoin?
Because when you issue preferred shares with a 12% dividend, you are legally obligating yourself to pay out cold, hard fiat cash to those shareholders on a very regular schedule.
I see.
Right. You cannot pay that dividend in Bitcoin, especially not when Bitcoin is down 20% from your purchase price. You need traditional U.S. dollars. So that $2.55 billion reserve policy is their fiat war chest. It ensures they can pay their creditors and shareholders for the next year and a half, regardless of what the crypto markets do.
But the optics of this are just fascinating. I mean, you spend years telling everyone on social media to have diamond hands, to literally never sell, and then you quietly authorize a $1 billion liquidation to save your balance sheet.
Yeah, the internet did not take it well.
The critics were out in full force. Ripple CEO, Brad Garlinghouse, and a dozen others were just tearing into this pivot. Does this validate the skeptics who warned that Strategy Inc. was dangerously over-leveraged?
Well, we have to separate the social media outrage from the pragmatic reality of corporate finance. The critics on X are hyper-focused on the hypocrisy of the marketing narrative.
Right.
But Wall Street actually liked this move. Strategy shares jumped about 6% in pre-market trading immediately after the announcement.
Really? Because it proved the executives were actually willing to pull the ripcord if things got dangerous.
Yes, exactly. The market was terrified that they would stubbornly ride the ship down to zero out of sheer ideological pride. This pivot proves they prioritize corporate survival over religious holding. They are ensuring they have the hard U.S. dollar liquidity to weather a prolonged downturn, which, positions them to actually survive until the next macroeconomic shift.
And while Strategy Inc. was frantically hoarding traditional U.S. dollars to stay alive, a massive alliance of traditional finance giants was busy reinventing how the digital dollar actually functions on the internet. We saw the launch of Open USD.
Oh, this was huge. This is a direct, highly calculated attack on the current market structure.
It really is. Open USD is an independent consortium of over 140 companies. And we are not talking about small crypto startups here. We are talking about BlackRock, Coinbase, Stripe, Visa, and MasterCard all teaming up to launch a new stablecoin.
A powerhouse lineup.
Yeah, and the target is squarely on Circle's USDC model. OpenUSD does two very aggressive things. First, it eliminates all minting and redemption fees. And second, it distributes the underlying treasury reserve yield back to its distribution partners.
That second point is the fatal blow to the traditional stablecoin playbook. Historically, a company like Circle would issue USDC, take the billions of real dollars backing it, park those dollars in U.S. treasuries, and just quietly pocket all the interest.
Which is a fantastic business model.
It is a brilliant, highly profitable business model for a single issuer. But OpenUSD flips that entirely. They are taking that treasury yield and sharing it with the exchanges, wallets, and payment processors that actually drive the adoption in the first place.
I see in our notes that this was enabled by the Genius Act. But how exactly does a piece of legislation suddenly allow BlackRock and Visa to share treasury yields on-chain without the SEC instantly stepping in and classifying the whole thing as an unregistered securities offering?
All right, so the Genius Act provides this specific regulatory safe harbor the industry have been begging for. Without getting too bogged down in legislative text, it establishes very clear criteria for what constitutes a payment stablecoin versus an investment contract.
Okay.
By mandating strict reserve audits, dictating exactly which short-term treasuries can be held, and standardizing the disclosure of yield-sharing agreements, it basically gives legacy giants the legal cover they need. It essentially says, if you follow these very strict operational rules, you can distribute programmatic yield to commercial partners without triggering traditional securities laws.
Which explains why Visa and MasterCard are suddenly comfortable putting their logos on this. But for Circle, the market impact was brutal. Their stock plunged over 12% to a 4-month low immediately following the OpenUSD announcement.
Yeah, the market saw the threat immediately.
And Jeremy Allaire, Circle's CEO, went straight on the defense. He leaned heavily into the idea that USDC is the most trusted, battle-tested, and regulated option available. But put yourself in the shoes of a payment processor or a major exchange.
Right.
Circle is like a dominant paid streaming service that has held a monopoly for years. You trust it, it works. But suddenly, every major movie studio and tech giant forms an alliance to offer a platform that is faster, completely free, and they actually pay you a cut of the ad revenue just for streaming their movies. Can a history of trust alone really beat an alliance offering free money and shared yields?
In the long run, economics usually win.
Yeah.
The era where a single issuer can hoard all the interest is likely over. When BlackRock and Stripe agree on an open standard, it validates stablecoins as foundational global payment infrastructure.
That makes sense.
However, you cannot ignore the massive operational risk here. Governance. You have 140 fierce corporate competitors, companies that actively try to destroy each other in the traditional markets, who now have to coordinate the operations of a single digital asset.
Oh, wow. Yeah, how does that even work?
Exactly. How do they vote on an emergency pause if there's a hack? How do they deploy contract upgrades across multiple blockchains like Solana, Base, and Stellar simultaneously without a centralized point of failure? That is a monumental logistical nightmare.
That is a great point. A consortium is really only as strong as its ability to agree during a crisis. But this push to integrate traditional finance with digital infrastructure, it brings us to our final major development of the week. Because all of this institutional maneuvering finally trickled down to the retail user. Robinhood effectively vanished the barrier between a traditional consumer brokerage and decentralized finance.
The launch of the Robinhood chain. They rolled out their own Layer 2 mainnet built on Arbitrum's technology stack.
And the feature set is extensive. They introduced 247 tokenized stock trading via their Arcus integration. They rolled out decentralized USDG lending targeting a 7% annual yield. They even debuted AI-powered agentic trading for U.S. users, which allows algorithms to basically execute trades within parameters set by the user. And they are pushing this globally into Canada, Singapore, and the U.K.
It's a massive feature dump.
It is. But I have to ask about the mechanics of this because it feels surreal. You have everyday retail users, like people who just use Robinhood to buy fractional shares of Apple on a Tuesday, suddenly interacting with highly complex crypto infrastructure. How does this actually work under the hood without terrifying the average user?
That is the magic of Layer 2 abstraction. Under the hood, Robinhood is utilizing highly complex systems. When a user clicks buy on a tokenized stock, The Arcus integration is acting as a bridge, wrapping a traditional equity into a digital token.
Right.
When they opt into that 7% yield, their funds are being routed into decentralized USDG lending pools, relying on Chainlink oracles to monitor price feeds and ensure the loans remain over-collateralized.
But the user doesn't see any of that.
Exactly. Robinhood is paying the gas fees on the back end. They are managing the private keys. The user just sees a clean interface, zero fees, and a shiny button that says, earn 7%.
Which brings up a serious debate. Does abstracting away all the crypto elements actually drive meaningful adoption of the technology, or does it just hide the very real smart contract risks from mom-and-pop investors who think they are just using a normal FDIC-insured banking app?
That's the million-dollar question.
Right, because if a liquidity pool gets exploited on the back end, the everyday user has no idea what just happened to their money.
The risk definitely does not disappear. It just shifts from the individual user to the platform itself. Robinhood is taking on the burden of auditing these smart contracts and ensuring the bridges are secure.
Assuming they do it right.
Right, assuming they do. But from a structural perspective, this is how mass adoption actually happens. Nobody wants to manage a seed phrase or calculate network congestion fees just to lend out their spare cash. By bringing millions of active retail users onto zero-fee, on-chain rails, Robinhood is acting as a massive catalyst. They're forcing a huge wave of capital into the Ethereum Layer 2 ecosystem.
So it's a net positive for the builders.
Absolutely.
Yeah.
They are normalizing decentralized rails for the masses, which provides the deep liquidity that developers desperately need to build more complex applications.
Okay, let's pull all of these threads together. If we filter out everything else, what actually mattered this week? The true signal is that the transition from closed, walled gardens to open, compliant infrastructure is fully underway.
Yeah, the days of operating in the regulatory shadows and relying purely on retail hype are completely over.
We saw Binance lose its European dominance to fully licensed rivals simply because they missed a regulatory deadline. We saw the Open USD consortium prove that the future of digital money requires shared economics, not a monopoly hoarding the treasury yield. And we saw Robinhood prove that the future of retail finance is decentralized rails hidden behind a perfectly smooth, traditional interface.
We also need to explicitly label what was mostly noise this week, though, because there were some massive distractions in the feed.
Yes, two major stories dominated the headlines, but absolutely shouldn't distract you. First, the financial disclosure reports revealing that Donald Trump earned over $600 million to $1.2 billion from various meme coins.
Right.
And second, the highly viral social media stunt by a user named Vipu, who delivered this dense, buzzword-heavy fake reveal for a project called World XE, completely satirizing crypto hype. And we are just reporting on the existence of these stories, not taking a stance on the politics or the stunts themselves.
Right, and both of those stories generated off-the-charts engagement metrics, but neither of them has any impact whatsoever on long-term market structure, technological development, or institutional capital flows.
Exactly.
They are pure engagement farming. If you were trying to understand where the global financial system is actually heading, you can safely ignore them.
So looking ahead, what should you actually be watching next? There are three key catalysts to monitor in the coming days. First, how does Circle strategically respond to the Open USD threat? Do they attempt to cut fees, or do they completely restructure their yield model to compete?
That's going to be fascinating to watch.
Second, keep a close eye on Strategy Inc.'s SEC filings. We need to see if they actually begin executing those massive Bitcoin sales, or if the mere option to sell and build a fiat reserve was enough to calm their creditors.
And third, watch the volume metrics on the new Robinhood chain. We need to see how much retail capital actually flows into those new 7% yield products now that the friction has been removed. That will tell us if abstraction truly drives volume.
Spot on. Well, that wraps up this deep dive. Thank you so much for spending your time with us. If you want to stay ahead of these structural shifts, make sure to follow Nifty Noon on X and subscribe to our newsletter on Substack. We're here to make sure you get the ultimate signal in a market full of noise.
Focus on the mechanics, understand the capital flows, and ignore the distractions.
You know, it leaves us with one lingering question. If Robinhood successfully abstracts away all the complex crypto elements, and traditional finance giants like BlackRock and Visa end up controlling the stablecoins that power the system, does decentralized finance just become a faster, more efficient backend for Wall Street, defeating the original purpose of crypto entirely? Something for you to think about. We will see you next time.